four key messages I wanted to get across, that this isn't just the European story. Europe is affected, but there are asset closures in Asia. There's margin compression across the world. The second of which is that it's not just a China overcapacity story. And then thirdly, it's a global story. The fourth one is demand.
This podcast is for informational purposes only and does not constitute investment, legal, or tax advice. The views expressed by the host and guests are their own. Listeners should consult professional advisors before making any investment decisions.
Welcome to Fix and Floating, the credit podcast. I'm Josef Pschorn, and in each episode, we explore the forces shaping credit markets. Today, we are discussing the upheaval in the chemical sector. And I'm very pleased to be joined by Tim Riminton, a senior credit analyst at Bloomberg Intelligence covering chemicals. We first connected a couple of years back when we discussed ThyssenKrupp at your time at Barclays. It's great to have you on the show, Tim. To get us started, could you give listeners a quick overview of what you do at Bloomberg Intelligence?
Joseph, thanks so much for having me on. It's a pleasure to be here. I really hope I can use this time to shed some light on what I think is a really fascinating sector. I've been covering basic materials sectors now for over 7 years, and that's starting off with Russia basic materials, and I've been covering chems more closely for about 4 years. And there's a lot of moving parts. Hopefully we'll shed some light on them. As I said, my role here at Bloomberg Intelligence, so we are a research provider. I guess kind of similar to the sell side. We write research reports, we do in-depth analysis, and we publish them onto the terminal. And then, similarly, we have meetings with clients. We are a team now in Bloomberg Intelligence of over 500 analysts, covering, almost every sector, especially on the equity side. We're still growing a bit on the credit side. I now am the senior analyst covering basic materials. I look at both European and US names. And given what we're about to discuss, my focus has sort of remained on chemicals, given the stress in the market there.
That sounds like very independent research, Tim. The chemical sector has been always very cyclical, but this downturn feels very different to the cycles before. Do you think we are witnessing a once-in-a-generation structural reset, or is it ultimately only another very severe but familiar downcycle?
You started with the easy question there. I hope we can sort of unpack that. There are a lot of moving parts going on right now. I think, the headline would be that we're more on the side of this is a once-in-a-generation shift going on rather than a normal down cycle. The down cycle has been going on for 3 years and counting, and basically the market doesn't expect this to end before 2028 at the earliest. That's being reflected in spreads. In the European high-yield chemical sector, we're around 600 basis points over on a Z spread basis. It was flat to the index just in February and March, so huge underperformance there. Anybody who covers high yield credit, I'm sure will have noticed in their portfolio, the sort of negative returns that you're seeing in the sector. It has been an evolving story. But this year, I think the market has sort of really paid attention, not helped by, of course, the tariff disruption, maybe kicking the sector while it's down a bit. In terms of what I'm going to say today, I think there are 4 core messages I want to get across. The first is this is not only a story about Europe. The second is it's largely a Chinese story, but not actually a straightforward China overcapacity story. Thirdly, it's a global story about a global market. And finally, it's a story also about demand.
To set the foundation, can you briefly frame the chemical sector for us? What does it include? How is it structured? And which main segments should investors focus on?
Yeah, so chemicals is really interesting because it kind of covers everything around us. So what do we, what's the bulk of sort of chemicals by volume, and covering, sort of a big chunk of the issues as well. That is polymers, i.e. plastics. So that's kind of a solid hydrocarbon. And that is in terms of the tonnage of chemicals production, that is the bulk of it, and excluding ag chems, I should add. And that's about 450 million tons of production per year. That consumes about 5 or 6% of global oil production, and that's been rising as a share. Okay, gradually, but it has been rising as a share. And what is that correlated to? It's basically correlated to everything. It's the people in the industry like to talk about it as a GDP plus sector, because it's been growing steadily for decades now, above the rate of growth. And that's been driven by sort of rising middle classes, the increasing use of plastics to replace other materials like metals, glass in packaging, and also just its greater use in goods from electronics to home furnishings, fabrics, clothes, carpets. It's kind of everywhere around you. You're probably touching a chemical from virtually the moment you wake up to the moment you go to bed, and maybe even when you're in bed as well. So they're all around us all the time, and they cover sort of every end market you can imagine. So the one of the biggest end markets, sort of unsurprisingly consuming a lot of raw materials, is construction. And that uses about 20 to 25% of chemicals. And then autos, another big one, another huge good in terms of just its physical size, and raw material consumption. That's kind of another 12 or 15%. And then consumer goods, packaging, fabrics, home furnishings, electronics, these sort of things make up the bulk of the rest. Um, and a lot of it is linked to consumer spending. So packaging is about 20% of the market. Of course, that's not all packaging for consumers. A lot of that is, industrial packaging, use of um, uh, use in sort of industrial transportation and things like that. But you can see this sort of in your everything from your sort of cosmetics to your plastic drinks bottle, to the plastic wrap around some food you might be buying in the supermarket. The chances are that those are all going to be made of various grades of chemicals. Um, and then on the more specialist side, you've got products that go into pharmaceuticals, into high tech materials like carbon fiber, materials that sort of helping the carbon transition. So you've got these obviously growing use of wind, and actually the blades on those wind turbines are made out of increasingly sort of advanced mix of sort of carbon fiber and glass fiber composites. That's a whole sort of growing specialist area in the industry. And then, sort of it's a little bit separate, but it's included in chemicals when people talk about the sector overall, but slightly different drivers are ag chems. And that would include, fertilizers, but also crop protection, pesticides, herbicides, things like that. In this conversation today, I mean, I can talk about all of those to varying degrees, but I'm going to be focusing more on the commodity side, a little bit on the intermediate side, and that's sort of the bulk volumes of some phrases that might be familiar to some of your listeners, like high density polyethylene, HDPE. That is basically your your average plastic container. Another key one is polypropylene. Just as a reminder, when you're saying poly in front of these chemical names, that normally means it's a plastic, i.e., the hydrocarbon molecule has been polymerized into a solid.
Could you explain in very simple terms how the industry transforms oil and gas products like plastics, bags, or forks, and also like higher value added products?
Yeah, so essentially, there are a couple of different modes, but the sort of the most used form primarily, and again, lots of different value chains. So I'm just going to focus on what we call olefins or ethylene, and that is created primarily from oil. So you extract the crude oil from the ground. That is then sent to a refinery. The refinery distills the crude oil, and you get a bunch of different products from that. You get your gasoline, your jet fuel, your bitumen, and you also get this thing called naphtha, which is sort of a mid distillate. And one of the uses for that is in chemical production. So basically, you have this liquid oil derivative. It is then put into this complex called a cracker, and it's essentially heated to very high temperatures under very high pressures. In the presence of a catalyst, the hydrocarbon molecules from the naphtha basically shift into different chemicals. So out of this process, you get primarily ethylene, and you also get a bit of propylene. And those two raw ingredients, olefins, they're kind of the backbone of virtually the whole chemical value chain. They link to virtually everything else in the chemicals world, and they are the largest of the chemicals world in terms of the amount that's produced. When you've got your ethylene, ethylene is a gas. It's quite a light gas actually. So not there are uses for that. It can then go into sort of pharmaceuticals and various sort of intermediate products. But when we're talking about creating the plastic fork you mentioned, it would then be transported probably by pipeline to a facility that polymerizes that ethylene. So, as we were saying before, you've got a slightly different process, again, in the presence of a catalyst, under pressure, at an elevated temperature. You can get these ethylene molecules to sort of bind together. And then out of this process, you get little pellets of polyethylene. So that's your solid plastics. And then basically the final step is that you're probably going to ship this off, depending on where you are on the chemical value chain. A lot of the companies just sell these pellets on to other companies, and then they'll sort of melt them down. And there are various different methods for this, but you sort of you can blow mold the plastic into a sort of a shape, and then out of the back of that, you sort of you get your fork or your plastic bag, or pretty much whatever else you can imagine. Obviously, there are various things you can do to that polyethylene to make it to give it different properties, to make it more flexible, to make it stronger. But primarily that process I just described is sort of the bedrock of the industry.
That makes a lot of sense. If we zoom out historically, how has the chemicals industry evolved over the last couple of decades?
Yeah, so I mean, it's been a story of really rapid growth in consumption and production. So I've got a slide here, which is global plastics production since the beginning of the century. And basically, for those of you that are listening, it's pretty much a straight line up from 2000 to where we are now in 2025, with a very, you can hardly see it, a very slight dip in 2008. And that is 180% growth in plastics production in that 2.5 decades. It's pretty consistent. Like I said before, it's GDP plus, and that has just been going on with this rapid increase in consumption, and that's a function of some of the things I was mentioning before. As plastics have become more widely available and cheaper, they find more uses for them, and they're pretty useful in packaging and construction and all of the sort of the major industries there. So I think I guess the one of the ways we want to talk about, or we end up talking about the industry, is we break it down into the three key consuming and producing regions. So you've got Europe, you've got the USA/North America, and you've got APAC, Asia Pacific. Obviously, we're not leaving out the rest of the world, but the rest of the world historically has been less important in terms of the overall consumption and overall production. It's starting to change now a little bit with India and the Middle East, but broadly, we're kind of going to focus on those three key regions. So to give you a little bit of background, Europe. So this is kind of the birthplace of the chemicals industry. We've got the biggest chemical company in the world there, BASF in Germany, and they have a lot of older assets now. They're until well, it's under construction now. We'll get onto it later, but Ineos is building a new cracking facility in Europe, and it'll be the first one built in over 2 decades, probably almost 3. So it's been a region that sort of was built up in kind of the 60s, 70s, a bit in the 80s, and it hasn't really been massively built up in terms of old school cracking capacity since then. And then you've got the US, so that is a newer asset base. And here we've got quite an interesting story actually, because the landscape in the US has really shifted. So historically, the US, like Europe, used to be based on these naphtha crackers, these crackers that use oil as a feedstock. But then we had the shale oil boom in starting in about 2012, 2013, give or take. So I've got my next slide up at the moment, and this is, by the way, an index you can find on the terminal. If you search for oil to gas ratio on the terminal, you'll be able to find this. But this is essentially a chart of Brent crude oil prices to US Henry Hub, which is US gas prices. And what you can kind of see is that ratio was a lot lower it started creeping up in 2010, 2011, and it's remained a lot higher since. And what that is kind of telling you there is that it's a lot cheaper for America or US producers to make chemicals from gas as a feedstock as opposed to oil as a feedstock. And this has given the US a huge advantage on the cost curve. The other region that benefits from this is the Middle East. But essentially, this is a product of having a lot of ethane. And ethane is not all gas. It's just it's often a small part of your gas that you're extracting from the ground. And then gas that's extracted from the ground goes through a refining process like oil does, so that the gas that goes to your home is sort of stable and not full of all sorts of unnecessary and potentially hazardous sort of side products, and mainly is methane, which is sort of what you're burning to cook your food and heat your boiler. And ethane is one of those sort of contaminants that they extract, and shale gas happens to have a very high share of ethane. And really, ethane doesn't have a huge amount of value outside of chemical production. So as the shale oil boom got off the ground and US gas production skyrocketed, they just had so much of this ethane sloshing about. And chemical companies were like, okay, well, we need to use that. This stuff's getting dirt cheap because there's a surplus. Um, so, over the past sort of decade and a half or so, there's been a lot of new cracking capacity in the US. And because of that shale oil dynamics, it is, along with the Middle East, the most cost advantaged region in the world. And that brings us on to Asia. And Asia is the fastest growing of these core markets in terms of demand. And recently has become the fastest growing in terms of capacity. So China consumes about half of global chemical production. It's a rapidly growing industrial focused economy. It also obviously ships a lot of goods around the world, and what do you need to create goods? You need plastics and other chemicals. But basically, up until recently, it only produced about 40% of the world's chemicals. And that obviously sounds like a very big number already, but it did mean that China was a huge importer of volumes. And basically, the current build out is China trying to change that. It wants to become self-sufficient. We'll get on to that, I think, a bit more as the conversation goes on. But I think the key thing to know about the Asian market right now is that as China is transitioning to this aim of self-sufficiency, it's created surpluses in other regions, and especially for other APAC producing countries, i.e., South Korea, Japan, Taiwan, which previously were big exporters of chemicals into China, and now suddenly China doesn't need those volumes, and that's kind of like a big part of the current crisis we're in. And margins for chemical producers have really collapsed. They're the worst right now in Asia of all of the main regions.
Tim, you just mentioned that China has shifted from being a net importer to a largely sufficient player, and in some instances being even a net exporter. What does that imply for utilization rates across the globe?
Yeah, so I mean, sadly, we're not actually through this build out yet, and believe it or not, in a lot of value chains, China isn't even yet self sufficient. So there's more new capacity set to come online, and this is reflected in my chart here. I've got so for just to explain it quickly, it's the same chart I showed earlier, and with the long term growth in chemicals production, but I've overlaid the operating rate over the top. So that is essentially telling you how much of global capacity is operating, and sort of what percent on a globalized basis. And the story is that we've been around the low to mid 80s, with the exception of post Great Financial Crisis, up until about 2021, when we've just seen this really big drop off down into the high 70s. That might not sound like a huge difference, sort of 4, 5, 6 percentage points, but it is huge in this market, which is globalized and very competitive. And just to put that in context, where we are now in 25 coming into 26, utilization is actually set to be lower than it was post Great Financial Crisis. And this is Nexent projections. We're not actually expected to come back to sort of 80 even into early next decade. So this is going to be a protracted period of overcapacity. Obviously, what can solve that is if some of these projects that are planned don't come online. Our colleagues at BNF think most of the ones that have been announced will be coming online. I think obviously the further you get out, the more uncertainty there is there. We've had companies like Dow essentially delaying their plans for a big new cracker in Canada. So there are plans to some new capacity changing there. And the other thing is capacity closures. We've had quite a few announced in Europe already. Up to about 20% of cracking capacity in Europe is closing or will close in the next couple of years. And we've had some announcements in Asia as well. There'll probably be more to come, given how sort of deep this down cycle is. But the sort of the key message there is that we currently do have global overcapacity, and that's reflected in the operating rates. And really, we want to get back to the sort of ideally mid 80s for overall profitability in the industry to to sort of be sustainable on a long-term basis.
Chemical production in Europe has declined over the last couple of years, as energy prices in Europe have been substantially higher than in the rest of the world. But it has also collapsed in Japan and South Korea. Could you explain the drivers behind Europe and Japan's and South Korea's downfall?
Yeah, so for Japan and Korea, the key thing there is that the Chinese market is kind of getting, it's no longer economic for them to produce volumes and export into China. There's less demand in China, and margins have been really compressed. So that's kind of the big drivers in Asia. And then in Europe, you've got a few other things sort of coming into the mix there. Part of it is the rising energy costs for Europe, and that's sort of been harmful for Europe, not only because these companies are big energy consumers, but also because a lot of these volumes are going into other industries that are quite sensitive to energy prices as well. Thinking about autos, for example, the energy crisis has pushed prices up across the continent. We've had quite severe inflation, here in the UK and the rest of Europe as well. And that sort of pressured consumers' capacity to buy goods. Sort of a big narrative in the market right now is the idea of this K-shaped recovery. We have consumer spending being propped up by a smaller part of the population that are higher earners, and a larger part of the population, in the sort of the bottom 2/3 or so, they are still under cost of living pressures, and maybe aren't spending more. And the issue for chemical companies there is that they are largely volume businesses, and the consumption of the wealthy isn't going to offset all of the lack of consumption for the rest of the population. Europe is actually still, but was more so, an exporting region for chemicals. So partly it's always, well, not always, but for quite some time it's been a higher cost region, but that hasn't been such an acute disadvantage when the market was more balanced. And also when the market was more balanced, there was still demand for that volume that was being produced in Europe, even if it was a little bit more expensive than getting it from the US. But when margins are a bit wider, there's just a bit more flexibility for everybody in the market. The other part of Europe's export chemicals business is more high-tech specialty chemicals. Companies like BASF, Lanxess, Arkema, and many others, they have the bulk of their assets in Europe. They built up these really complex integrated facilities that create quite complex molecules. And they haven't fully replicated those in other regions. So, some of those more advanced products were sort of being primarily produced in Europe, and to some extent that's still the case. BASF, Lanxess still export chemical volumes to the US, despite the US having advantages. It's just the specific molecules they can create still have value in doing so. I think obviously the issue is the longer that the price discrepancies go on, the more incentive there is to, sort of build a new facility in the US or, the Middle East or wherever else you can get a cost advantage and maybe wind down your European one. I think, we're, like I said before, we're 3 years and counting, and we're getting closer to the point, if there's kind of no recovery in sight, that some of these more structural decisions are starting to be made. And like I said before, the closing of about 20% of European cracking capacity is part of that. You know, Probably when these facilities are closed, they're not going to come back. That's kind of been the story with industry in general in Europe over recent decades. Sort of across many different industries, once the facility closes, it doesn't tend to reopen.
Touching on a very important point here, global versus local. Um, how much of the industry is truly global versus local? So, what share of production is typically exported rather than consumed domestically? And also, an important point is how easy can chemicals be transported?
Uh, how long is a piece of string? It kind of depends on the value chain, and also I think we should unpack this in just a moment. But chemicals is fundamentally a margin business, and when you get sort of pricing and cost based discrepancies, suddenly transporting molecules that didn't make sense before can make sense. So, kind of uh, historically, well, in recent history, the regions like the US, the Middle East, and non Chinese APAC were big exporting regions. And like I was just discussing, surprisingly, Europe was as well. And what we're seeing now in this sort of ongoing structural shift is that changing. So Europe is exporting a lot less, and that trend is probably going to continue. And non-APAC China is exporting a lot less as well. And again, that trend is probably going to continue. Neither of those regions have cost advantages. Cost advantages in the US and the Middle East, that probably means that they're going to continue exporting. And to give you some rough numbers on that, the US exports about a third of its production on the chemical side. So it's really quite material to their market. And that is actually what's causing the US market to see its margins sort of crumble as well. You'd think that given it's got by quite a margin a much lower cost base than the rest of the world, bar the Middle East, that it could sort of ride through this downturn without too much issue. But the problem is that if a third of your output every year, ideally, goes to export markets, that those export markets are becoming more and more oversupplied as the capacity build out from China displaces those volumes sort of around the world. Those other regions that used to import China used to import from. So the export market, suddenly buyers in Latin America that used to buy lots of US volumes, they're getting offers from the Middle East and from Asia Pacific. So the US has a lot of competition for its margins, and even though they're producing at a lower cost base, you're eating into the advantage, the sort of the further you're shipping the product as well. In the Middle East, massive export region, about 70+% of its production goes to export, and that just sort of aligns with its position as a huge oil and gas producer and exporter. Chemicals is just a different form for it to export those same molecules at the end of the day, which it has in abundant supply. Saudi Aramco, biggest oil company in the world, a key part of their strategy, for the upcoming decades is increasing their presence in petrochemicals. Because if you're worried about, electric vehicles, possibly even electric or hydrogen powered aircraft, more use of renewable sources of energy. All of these things, are expected to sort of see demand for hydrocarbons to be burned and consumed that way to sort of decline over the coming decades. So you've got to find a new way to sell your asset base, your products, your molecules, and they've kind of been pivoting a bit into chemicals. So and that is part of the build out that's ongoing. We can actually just take a look at one of the slides I've got here in terms of the China chemical supply wave. This is sort of annual net new production capacity on the olefins value chain. So that's your sort of your key ethylene and propylene. And you can see that China is the bulk of this, which is the orange bars for those that can see. But the Middle East, the green bars, they've got a fair bit of capacity coming on through this period as well. So it's by no means 100% a Chinese story in terms of this new capacity, and there's there's probably going to be more coming on in future decades as well. Obviously, we hope or kind of expect that what will be coming on in future decades might be a little bit more balanced than what we're seeing now in terms of its matching to demand expansion.
Going from macro to micro, what does the current environment look like for chemical producers today from an operational point of view, but also from a financial point of view?
Yeah, it's been a big shift. Chemicals, as I'm sure all of your listeners know, is a cyclical industry. I don't think, I mean, I didn't appreciate it until I started covering the industry, just how cyclical it can be. So, to kind of put that in context, one of the issuers in my coverage saw EBITDA fall 60% quarter on quarter from Q2 22 to Q3 22. So that is kind of just how fast earnings can respond to a negative shock. That negative shock obviously relates to the Ukraine war, inflation, higher rates, and sort of the end of the COVID boom in goods demand. So there are quite a few moving parts there. That's not a normal fall, but certainly unusual across most credits. The reason for that is, as I kind of alluded to just then, is that, chemicals businesses are margin businesses. Historically, a lot of these assets were integrated into oil and gas producers. So they'd be essentially attached to refinery complexes, and part of your refinery producing naphtha that would go straight into your chemical cracker, and et cetera, et cetera. Then there was a big shift away from that kind of in the 80s following the oil shocks that we saw in the 70s, and also economic disruption, higher rates that we saw in the 80s as well. These oil and gas producers decided that they didn't really want these assets anymore, and started spinning out those units, selling those assets to other companies. One of the buyers was Ineos, which I think we'll talk about a little bit later. But the result is the majority of the industry, especially in the West, are these standalone chemical companies which operate as margin businesses. What I mean by that, they buy feedstock, largely oil and gas, hydrocarbons. They then convert it into this chemical product and sell the product. The profit they make is that margin from between the cost of raw materials and the selling price. And the fixed cost as the overall share of costs for them is quite low, but it's quite high as a percentage of the overall margin that they're making on the product. So when margins come under pressure, why would that be? Essentially the price component, like the headline price of a chemical, is largely dictated by the feedstock price going into it. So the oil price, the gas price, that sort of thing. So we don't tend to pay too much attention to the revenue of a lot of these chemical companies, because if oil prices are up, probably revenue is going to be up because those headline prices are going to rise. But the revenue change doesn't really always, or hardly ever, feed directly into what we're seeing on the EBITDA, the earnings, because that's all driven by the difference between the selling price and the cost base. So there are a few moving parts here, but basically when those margins come under pressure, let's say feedstock is saying the same price, and that's making up sort of 80% of your cost base. You've got another, let's say, 10% fixed costs, so you've got 10% margin you're making on your overall product. Well, the next quarter, if there's a bit too much demand has fallen away, the headline price can come down, and keeping all else equal, that kind of means that's just your profit that's being hit, assuming that feedstock prices stay the same. And that means that your earnings can be very, very volatile, and exposed to small changes in the demand and supply balance. Basically, these companies don't really have, largely speaking, any pricing power. They do obviously have a bit of pricing power when markets are very tight. The cost to run that, aside from the feedstock, is actually relatively fixed, whether you're running it at 60% or 100%. You don't actually need any more people really on site if you're running it at a higher rate than you do if you're running it at a lower rate. You need a little bit more energy, a little bit more fuel, but it's kind of fixed. So, what does that mean for the product? It means that you really want to run your facility at the highest rate possible, to mean that your operating costs, your fixed costs, are a smaller share of each volume that each ton of product you're producing. And that kind of creates distortions in the market as well, because even when demand is softening, a lot of producers will try and run their assets harder than maybe they should be run, and that ultimately ends up pushing margins down further. But maybe you want to try and ensure you don't lose market share to your competitors, or you want to try and take market share and be a bit more aggressive. You can do that, and these assets can be sort of turned up and down within days, or even hours if it's a smaller range. And that is very different from other basic materials sectors, so mining or steel. If you want to, I guess a steel blast furnace is kind of the equivalent in that sector to a chemicals cracker. You're mining the iron ore, you're mining the coal, and you're putting both of them into this processing machine, and out of it you get steel. Kind of similar to the dynamics we see in chemical markets. The difference is that for a blast furnace, they basically operate in quite a narrow range. You can't really go below 80% utilization on something like that. So if you need to go below 80% utilization, i.e., you're losing money, you have to make a decision as a business, right? Do I carry on losing money and hope that the sort of the issues facing my bit of the steel market subside, or do I mothball it, i.e., sort of put it in a sort of a temporary closed state, and that mothballing process alone takes 2 or 3 weeks, and if you want to restart, it's going to take up to 3 months. So demand and supply can't demand can obviously change quite rapidly, but supply can't always change rapidly in the steel sector, and that historically has meant at times that you get very depressed earnings, but also very extreme earnings, because the supply base can't react fast enough to a change in demand. On the chemical side, that doesn't really exist. Demand can change and supply can adapt to that very quickly. And in an oversupplied market, which is what we see now, that's what's happening, and it's just keeping margins suppressed. Nobody wants to shut down their facilities if they can really avoid it. You don't want an asset sitting there on your books not doing anything, and at the same time, deciding to shut it down is a very big decision. As I was just saying, these things are not always restarted. You risk giving away your market share, your customer base, and in Europe, the cost of permanently shutting down an asset can actually be very expensive. You have to make large payouts to labor unions. Often you have to pay for site provisions, to clean up the industrial site. There's just quite a bit of regulation around that. So you don't want to make these decisions to close the assets too rapidly. And
Tim, that's a very interesting point. Who is actually then closing down the facilities? Is it like easier for larger corporates or easier for smaller corporations who only have like a couple of facilities?
yeah, I mean that's a really good question, and you would think uh, the larger producers would be better placed. They would be the ones being like, okay, we have the scale to sort of just weather this down cycle, and we'll let others sort of fall apart and sort of wait for things to go right. It's not actually what we're seeing. In Europe, we've had capacity closure announcements from some really big players like Dow Chemical, Shell, just to name a couple off the top of my head. And some smaller players have kind of held on, and I think part of the reason there is that if you're a small player with only two or three assets, closing down one of your assets, you don't have anything else to lean on. Whereas if you're a big player like Dow, you've got a huge asset base all over the world, including in the US, where you make the bulk of your earnings, and the bulk of your assets is. So closing down some assets that potentially are loss making in Europe, it's kind of like, oh, we'll take some provisions for that. We'll pay the shutdown fees, but actually we think EBITDA might improve after this, or the flip side is we don't need to spend the capex that that site needs to to have its big maintenance cycle on the cracker. These big maintenances called turnarounds, they can cost sort of 50-60 million plus. So maybe you just sort of Dow has mothballed one of their actually relatively newer crackers, because they don't want to spend that capex on it right now.
So that basically implies that smaller players are waiting for larger players to close down their facilities for them to recover operationally.
Potentially, I think if you're a smaller high yield player, you're kind of to some extent just trying to hang on for dear life. And I guess the missing part of the picture, just focusing on Europe for a second, a big missing part of the picture is demand, because not only do we have these pressures on European production as higher cost base region, high still high electricity costs, and greater pressure from imports. The sort of the one of the key missing points is the demand side. So we had a period of very high rates, and that sort of killed a lot of construction activity in Europe. It hit the auto sector as well. Essentially sectors that rely on consumers or producers needing a lot of financing. If rates go up, that becomes less attractive, and we have seen that now. Rates obviously in Europe have fallen to 2% now, so quite a lot lower than they were. I was expecting in 2025 to see some signs of solid signs of pickup on, especially on the construction side, which I think will be a benefit to the European chemical industry when it happens. We haven't really seen it yet. What we have seen, though, are the first leading indicators are that housing or construction permits, they have gone up. So that's good news. It's probably not going to mean sort of shovels in the ground and things happening until next year, maybe even the second half of next year. We'll have to see, but that is at least a good sign, and that is both in Germany and France, which are two of the largest construction markets in Europe. The UK, sort of the third biggest one, that still remains quite depressed and hasn't really shown much sign of improving. Kind of makes sense. Rates here are still much higher than they are on the continent, even though they've come down. It's been a lot slower, and construction sort of remains more sticky. The other part, of course, of the rates issue is that rates go up because they are fighting inflation, and inflation is still, consumers are still feeling the pinch from the inflation shock, and wages have not fully adjusted for the amount of inflation we've seen since 2020. So there is just sort of less capacity for consumers to buy a lot of physical things, and ultimately for chemical producers, that's what you want to see. So the whole industry is kind of hoping that we see this improvement, and just trying to get yourself through the down cycle. Kick the can down the road. Favorite strategy of high yield firms. Sometimes it works, often it doesn't. But yeah, there's a lot of hope coming into 26 that we might see some signs of improvement.
In years, Chairman Jim Ratcliffe has been very outspoken on dumping and unfair competition. What is happening in Europe specifically that has pushed these issues to the forefront?
So Ratcliffe he's been banging on about this stuff for a while now, mainly in the context of Europe. The anti-dumping, unfair competition. This is the result of this overcapacity we're seeing on the market, and there has been some successes in these anti-dumping cases that have been brought by some of his companies on specific value chains such as PVC, polyvinyl chloride, which is used a lot in construction. And after an investigation last year, the European Commission found that firms in the US and the Middle East had been selling products into Europe below the rate that they could get in their domestic markets, which I understand is essentially the technical definition of a dumping case. They are trying to bring more of those cases now, Ineos. They're trying to target more anti-dumping levies using the sort of existing mechanisms within Europe to try and protect domestic production. PVC, I should add, is a really high consumer of energy, so it has been quite hit hard by the higher energy costs. Again, there's some hope that gas prices have fallen quite a lot in Europe over the past sort of few months or so, and there's a lot of LNG capacity coming on next year, which is hoped to support lower gas prices as well. And potentially we'll see a peace or ceasefire agreement in Ukraine would probably help ease some of those price pressures too. But on the unfair competition side, that is more, he's kind of pointing the finger more at China. China is always a bit of a black box, so it's always difficult to get precise data on this sort of thing. But China has a reputation for subsidizing industrial production and keeping it going even when it's uneconomic. They get access to advantaged, essentially subsidized financing rates from local banks. And local governments, the sort of the way the structure works in China, you have these economic targets from the top, then they go down to the local governments, and the local governments sort of have to try and meet, whatever target it is, GDP of 5%, or improve your industrial production by 10%, and then they have to sort of work with what they've got in their region, and often that means they don't want to see plants closed down. That they'll probably have a target on unemployment as well. So if you're saying actually a lot of my chemical capacity in this region in China is not competitive right now, in a normal market some of that capacity would close down. You kind of like I don't want to do that as a local government manager or leader. So this is kind of what they're complaining about, because China, there is this huge capacity wave from China, but the other issue with it is, as these new facilities are coming online, they're running at really high utilization rates where they're probably not making money. Part of the reason for that is that you run these assets hard when you've launched them to prove that you can. Like this asset does work, it can produce its nameplate capacity. There might even be terms in the financing you got from banks that you need to run the asset at a certain amount to to prove to the bank that the asset is kind of what you said it would be. So they tend to get run hard. They're also new assets, so China isn't, generally speaking, cost competitive, with a few exceptions, with the Middle East and with the US. But it does have economies of scale in a lot of these new plants it's building. The sort of latest technology.
China has laid out in their 5-year plan that they want to focus more on quality rather than quantity with regards to chemicals production. What does this tell us about the composition of Chinese supply going forward?
Yeah, I've had a lot of questions on this. I'm not a China expert, but I have read a translation of the report they sent out, sort of addressing this issue. So there are a few points here. Obviously, we've got all of the new capacity coming, which is truly vast. I don't think really that this is going to be the stuff that's rationalized. It's brand new. It's the more modern integrated stuff. But they do have this large asset base, as I was previously mentioning, that is older. A lot of it running cold chemicals or just older facilities that are a bit less efficient. And there was hope in the market that this announcement might mean that actually they're looking at closing some of this older capacities over the next 5 years or so, and that would sort of dampen some of the threat we're seeing from the new capacities coming online. Having had a look at it, it doesn't really seem that that's exactly what they're saying. They talk about closing some of these facilities, but then they go on to say how they'll be closed to be upgraded to produce more specialty chems. And honestly, if I was a chemicals manager, at one of these big Western firms, I would kind of be a bit concerned by that, because that's kind of telling me that they're coming for us. They've come for the bulk commodity chemicals that they were importing a lot of, and they want to become self-sufficient in that. Okay, fine. And it's kind of like, okay, what's the next thing? Well, you got to move up the value chain, the specialty chems, and what is protecting my earnings. For a lot of these big Western companies right now, is the fact that we have specialist products that aren't so easily available. Some of them are patent protected, but some of them aren't. Or you just don't have many competitors in that specific chunk of the market, so you have more pricing power. If China is deciding to sort of come along and gain market share there, your pricing power is going to evaporate. And we're kind of already seeing this a bit in some areas of specialty chems already. Generally speaking, specialty chems held out a bit better. Sort of we had the initial crash in earnings in the first half of 22 and into 23. And through that period, specialty kind of held up okay. But since about 24 and definitely in 25, that narrative has not really held fast so much. We've seen producers like ones I cover like Celanese. They're involved in producing quite high tech engineering materials, largely derived from the nylon value chain. Historically this was a big moneymaker for them, but now those specialty chems are getting more direct competition. And also they're finding that buyers are switching to maybe less good quality polymers that are a lot cheaper as well, given the oversupply.
Given how distressed or depressed the current state of the chemicals market is, what does this tell us for other parts of the economy?
Yeah, I mean, I think this comes back to what we were speaking about in terms of demand previously. So, hopefully we've covered the sort of the four key messages I wanted to get across, that this isn't just a European story. Europe is affected, but there are asset closures in Asia. There's margin compression across the world. Even on the sort of the high yield spread side, US chemical companies are seeing underperformance there as well. It's not just European. The second of which is that it's not just a China overcapacity story. China is building a lot of capacity, but it's more self-sufficiency, and that is creating overcapacity in the world, but not strictly speaking Chinese overcapacity. At least, so far, that could change. And then, thirdly, it's a global story, and that kind of relates to the points I've just been making. But the fourth one is demand, and that is kind of what you're touching on here. I think the state of the chemical industry partly reflects a weak demand environment. And I think we've covered that in terms of the pressure on spending from inflation, from higher rates, but it also indicates weakness in the end markets for chemicals. For goods production, for construction, these sectors are seeing a dip in demand and have been for a few years. And they haven't really fully recovered. For some goods, there are theories in the market that COVID actually brought forward a lot of spending that would have sort of been spread out over years. People sitting at home, they decided they wanted that new TV and that new washing machine, and that maybe they would have waited some years before doing that. But now they've got the new thing, then they're not interested in buying the next one, this year or next year. The construction story is a big part of it as well. We haven't touched on it too much really, but China, their construction boom ended with a burst in 2021. And I've got a good stat for you here from our colleagues in BNEF. So in the 5 years before 2021, Chinese annual increase in polyethylene demand was 3 million tons, which is a truly colossal number. Since 2021, the annual increase in demand for polyethylene from China has been only 800,000 tons. So it's a huge drop. And it's possible we will end up with overcapacity in China because they were building a load of assets on the sort of, in a previous demand environment, which at least for the minute doesn't seem to be returning. And you probably need a good deal of construction and property growth in China that we haven't seen since the bubble burst there. And at the same time, construction markets, as we've discussed, higher rates and the rest, have been muted in Europe and the US. So the troubles of the chemical market are also reflecting a complex, demand picture.
Tim, thank you very much for a great discussion. Where can listeners find more of your work at Bloomberg Intelligence?
Yeah, so as long as you have a Bloomberg terminal, you can find our research. Firstly, please do feel free to reach out to me on IB. And you can find me on the Bloomberg terminal. You can type in my name, Timothy Riminton, followed by bio. That will take you to my page where you can see all of the research I publish. You can also hit BI Go, and that will take you to the BI landing page where you can see all of the different research across equities, commodities, rates, fixed income, credit that we produce, and the different dashboards we have there as well. I hope to hear from you. Like I said, please do feel free to reach out, and hopefully I've been able to share some insights with you all today.
Thank you, Tim, for coming on the show, and also thank you to everybody for listening to Fixed and Floating. If you enjoyed this episode, please follow or subscribe wherever you get your podcast, and see you next time.